Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. Recently, the McPherson Financial Group, y'all had an event that included conversations about ROTH Conversion analysis. Can you tell me a little bit more about that and how exactly does it work?
The reason why we're very excited about the ROTH conversion at this time and moment is the fact that we are at historically low taxes for tax rates. So the President Trump tax provisions that pulled back the rates and lowered the rates and the income levels that certain incomes get taxed at has created this little windfall for folks that if they have tax deferred money that they're looking to eventually get distributed for their retirement savings, there's a lot of sense to doing it now, to doing it today, to get it into the Roth bucket so that it's in the tax-free bucket. You trigger the circumstances have to be analyzed and we have to take a look and make sure that we have the right situation in place. But for a lot of folks, it makes a lot of sense to trigger it today to get it into the Roth because you start getting into RMDs and forced distributions when you turn 72. The rates will be higher at that point. And our projections show with the growth rates of the investments that you're really doing a lot better. In about 7 years, you break even. And then that money going forward is tax-free to you. When you pass, it's tax-free to your spouse. And when she passes or he passes, it's tax-free to your children. Mm-hmm. So you can have up to about 30 years of this money sitting in a Roth IRA growing if you don't need to use those funds. And when they get distributed in 10 years after the surviving spouse passes, kids have another 10 years and they can pull all that money out tax-free.
Here's a good example of one we just recently ran. It was a husband and wife. They had a pension. They have a couple kids. The lifetime estimated tax bill for them doing nothing, right, over their lifetime, right there in their 60s, was $1.7 million, right, they're going to owe in taxes. If they did our ROTH conversion strategy, it's closer to $950,000. So we're saving them hundreds of thousands of dollars in taxes by planning now. But it gets better, right? Mm-hmm. Mark was talking about how you can stretch it out for multiple, generations, your lifetime, and then the 10 years for your kids, right? Well, the tax bill for the kids was going to save them over $300,000. So it saves mom and dad cash and taxes, and then it's going to save your kids because they don't owe any taxes on that account, on those accounts that they inherit. So we run this analysis that takes your current situation, current incomes, your current IRA accounts, your current required minimum distributions, and say, okay, here's what happens if you do the same thing you're doing now, and taxes go back to the Bush-Obama tax code. We think they're going to end up being higher than that as we approach $30 trillion of national debt, mm-hmm. And then we give you the analysis that says, hey, here's what we think you should do and here's why.
Mark Bernard, CPA at McPherson Financial Group, joining us this weekend. Mark, I want you and Luke to kind of look at the checklist of things that we still can do and still can review as we approach the end of the year.
So it's really kind of lining it up and trying to figure out and estimate what the tax return and your tax liability is going to look like for the year 2020. And December is a good month to do that because most of the activities have occurred up to date. Mm-hmm. You kind of have an idea where your income and your IRA, 401k contributions and things to that nature. So, a lot of people, I usually, when I review people's returns, I start with last year's return and ask myself what has changed and then figure out the top line gross income numbers and what that looks like based on what it was last year and what you expect to see this year. The other things that are kind of important in kind of estimating what you're going to owe for 2020's activity. One is, what kind of deductions are you going to take? You're going to take the standard deduction, which is generally $24,400 for most married filings jointly. There's also itemized deductions. So there's a certain percentage. It's a lot lower now. They've raised the standard deduction to the point that most people don't need to itemize. But if you are itemizing, reasons why you would itemize is if you had a lot of medical expenses or you've made some large contributions to charities or there was a casualty loss of some sort. Those are the reasons why most people would end up itemizing. But if you don't have those things, most likely you're going to take the standard deduction. Once you have your taxable income and your deductions, you then can look at your tax liability. The U.S. tax code has what they call a graduated tax schedule. So the first $19,000 is taxed at 10%. then the following 50,000 is taxed at 12, and so on and so on. So you have to go ahead and go through a little bit of an algorithm to figure out what your tax liability will be. And then you can step back and say, okay, this is what I owe. What are some of the things I can do then at this point to maybe reduce it or take advantage of you being in a lower tax bracket? We talked about the ROTH conversion. That's one way to trigger some taxable income and boost it up this year because you're wanting to take advantage of these rates. The other thing is if you're wanting to reduce your tax liability, things like charitable contributions are still possible here as we wind down the year 2021.
Yeah, another thing I'll add to that, Mark runs a great spreadsheet here in the office where he'll take your last year's tax return and he'll input some numbers for this year based on, your income for the current year, and then basically create a tax return for you and come up with a estimated tax liability to see if it makes sense for you to do a Roth conversion, if it makes sense for you to give more to charity, or if you're close enough to getting over the standard deduction, right? How do you have more itemized expenses? One other thing I'll also mention is if you are at the age where you have required minimum distributions, and if you are charitably inclined, do that directly from the IRA as a qualified charitable distribution. Transfer it directly to the charity, directly to the church. That way it doesn't touch your tax return. Because right now, if it goes on your tax return as a charitable contribution, but you don't have enough to overcome the standard deduction, you don't get any taxable benefits. So avoid that hitting your tax return altogether. It'll save you some money.
And Mark Bernard hanging out with us here, the in-house CPA at the McPherson Financial Group. At some point after you retire, you will begin to collect Social Security, but it might surprise you to learn that you may have to pay some of that money back to Uncle Sam, being in the form of taxes. So over the next decade, retirees are expected to pay $650 billion in taxes on their Social Security benefits. But Mark, didn't we already pay taxes on that money while we were working?
Yeah, we've paid into the fund. It doesn't feel right, does it?
Right.
You work your entire life paying into the fund. And, this is kind of recent development, right? It wasn't something that was occurring during most of our grandparents' and parents' lifetime. This is something that's happened in the last 20 or so years where we've started to tax Social Security benefits. And we started with a small percentage that it seemed acceptable. The very rich that are receiving Social Security benefits, we'll tax them. But now that number has dramatically increased where you don't really have to make a lot of money, and 85% of your Social Security benefits is taxable income that you have to calculate into your adjusted gross income to figure out your tax liability.
Yeah, so this is a way for the IRS to kind of tax us from our paychecks going into it our whole lives, and then when we get it back, tax us on it again. So if we do our jobs correctly here at McPherson Financial Group and create out the plan for you, right, we won't have any more IRA distributions because it'll all be the Roth IRA. So that's tax-free. That means your capital gains bucket is tax-free, which also means your Social Security is tax-free. So everything goes hand in hand. If all those are tax-free, that means you're paying the lowest on your Medicare premiums, and it just snowballs. So if we can stop that snowball from getting larger, right, it takes 5, 6, 7 years to do it, but over the next 30, 40, 50 years of your life, it makes a ton of sense to pay a little bit more in taxes over the next 5 to 7 years.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.